Hey everyone. Some of you may remember this video from October 22nd or 21st, a new way to hedge Bitcoin exposure. I wanted to talk about how those hedges protected Bitcoin holders or holders in the ETF that track Bitcoin. But before I do that, I wanted to talk about something else which came to me while I was writing this. And that's this, is the launch of an ETF for an asset class, should that be considered a sell signal for that asset class? It didn't occur to me at the time when the new Bitcoin ETF was launched, but I was just thinking back to an experience in the late 90s, and I wrote here, see accompanying video for discussion of this chart. And this chart is a chart of Pfizer. And if you look at it, I'm going to expand this a little bit here. I think that's about 1998, Pfizer was trading at just below $45 a share. And then in early 2000, it peaked at about a little over $45 a share. And it didn't regain that price level until last year with the COVID vaccines. And the reason Pfizer came up was because that was essentially the prototypical healthcare stock or biotech stock in the late 90s. At the time, I was working for a mutual fund company, which was then called Alliance Capital. Now it's Alliance Bernstein. And there was an IPO of a new healthcare fund. I don't remember exactly. I think it was either 1998 or 1999. But I remember that Pfizer was one of the top stocks in it. And the reason was it was selling two of the biggest drugs in America at the time. In 1996, I think it was, it got a deal with Warner Lambert, which it later acquired, to sell Lipitor, the cholesterol drug. And then in 1998, it had the erectile dysfunction drug Viagra. It got approval to sell that in the US and in Europe, and that was huge. So Alliance Capital came out with a healthcare fund. I tried to track it down, but I think they changed the names of their funds with the merger. So this is just representative. The point is, healthcare was huge. The company came out with a healthcare fund, and that, judging by Pfizer, represented pretty much a high watermark for a couple decades. I mean, obviously, if you bought Pfizer at the time, or even the healthcare fund, you probably made money with dividends accumulating, but just the chart of Pfizer's price over the next 20-something years, and I mean, it didn't recover until the COVID vaccines that it co-marketed with BioNTech. So, something to think about. I'd probably have to do more research to see if it is a sell signal, but maybe it's something to keep on your radar. Another thing came to mind was commodities when Jim Rogers finally had those exchange-traded notes. I could have looked this up before doing this video, but I think that was kind of after the peak of the initial commodity boom, because he started to get into that at a kind of an nadir of the commodities in the late 90s, and then it was about 10 years later when he developed the exchange-traded notes. So anyway, let's look and see how hedging Bitcoin would have protected you. So the symbol for the Bitcoin ETF was BITO, goes public in October, I believe. Options trade on it soon after. And then between then, late October and now, Bitcoin was down 34.76% as of Friday, January 7th, and the ETF was down a tiny bit more, 35.32%. So we looked at two different hedges. Well, we looked at more than two different hedges in the video from October, but these are the two that haven't expired yet. And one has an expiration date in March. And that one, if you were to buy that one, you would be down. These are just screen captures of the current quotes on the options. So the put option had a $5.1 price. And since you had 5 option contracts, you'd multiply by 500 because each option contract represents 100 shares of the underlying stock. So, and you do the same thing for the calls, except with this call leg, because the call last traded a few days before Friday, we used the midpoint in the bid ask. So in any event, you would have been down 19.1% if you hedged with this collar as of Friday's close, rather than being down 35.3% unhedged in that Bitcoin ETF. Now, the interesting thing is we also looked at using the last possible expiration date available, which went out to January of 2024. And you get a totally different result hedging with that one. So in both cases, the initial hedge had a negative cost. With the one expiring in March of 2022, you would have collected a net credit of $1,050. And with the one expiring in January of 2024, you would have collected a net credit of $5,400. So because of that larger net credit, your net position value, as we kind of explained here, would have been $15,015. That means the total value of your stake in the Bitcoin ETF plus the value of your puts minus the buy to close value of your calls. And on Friday, if you did the same math, you would have been down 6.1% on your hedged position, versus being down 35.3% on holding Bitcoin, the Bitcoin ETF by itself, or slightly less if you just held Bitcoin. And we just close this out with a what to do now discussion, very brief. And the main idea is depends your bullishness on Bitcoin or lack thereof between now and the expiration time of the hedge. If you think it's going to recover in the near future, then you definitely want to buy to close the call legs of your collars to eliminate your upside cap. And depending on how bullish you are, you might want to sell your puts and buy more Bitcoin or buy more of the Bitcoin ETF. And if you're not bullish, obviously, you can take this opportunity to exit while strictly limiting your risk. So something to think about, and maybe we'll do a little more digging on the relationship between new ETFs or funds and how that asset class does in the future.